Hi, I'm Jeff Turnahoy, Head of America's Research at Lipper, and today I'm joined by Matthew Duch, Portfolio Manager of the Calvert Short Duration Income Fund. Matthew, thanks for joining me.
Thanks for having me, Jeff.
Matthew, let's talk about the strategy of your fund. What makes it different from its peers?
Well, I think it's primarily invested in credit as the main driver of returns. Certainly credit's been a big driver of returns across sectors lately, but we also have the ability to diversify into other sectors as we see it's prudent to take some risk off the table. So we're in the right space at the right time, but we do a great job of managing duration along with our credit selection and analysis. We're primarily a credit strategy with an eye to relative value across all sectors. And within that, we really use our PMs as traders as well. So we have an eye to the market, the feel every day, and so we act very quickly, but in a very thoughtful manner. And so when we look at things, we tend to get out in front of them as opposed to react. And I think that offers a great advantage to a credit-focused fund.
You talked about duration. Why is it so important to be in a short duration income fund right now?
Well, I think a lot of it depends on your outlook for rates. Certainly, short duration is less interest rate sensitive.
Okay.
So that provides a little bit of comfort for bond investors. Certainly, there's also a little bit of a give up in yield, but you get that protection. And so I think it kind of hits the sweet spot between someone who wants to maybe take some risk off from, a high yield or an equity investment, provides them a little bit more yield than, say, money markets. But then you also have maybe a traditional money market or ultra short investor that wants to maybe extend out and get incremental yield in a short duration fund. So it's kind of in a nice little sweet spot to hit a lot of different investors.
Okay. Is there a particular type of investor you think this is most appropriate for?
Well, again, I think it's for someone who is a little more risk adverse. I think we talk quite a bit about the risks to bonds and rates in this environment. And so the short duration definitely is less interest rate sensitive. So to the extent you want to be invested in debt, in bonds, then you're going to want to protect yourself. And that is really the person who we attract.
Okay. Now, in a rising rate environment, what might investors expect from your portfolio?
We've positioned ourselves for that. We do understand that investors are risk adverse and take losses much harder than they take gains, right? So we do protect against the upside of rates and the potential to lose. But the advantage of a short duration fund is that it's short. So to the idea that maybe rates go higher, bonds continue to get closer to maturity, and then they roll off, and you get to reinvest at higher rates.
Okay.
So there's the advantage of being shorter, also from interest rate insensitivity, but to the idea that bonds will mature over time, and you get to reinvest at higher rates.
Oh, okay. Matthew, what parts of your portfolio are poised to break out this year?
Well, I think this is a year for selection, and one thing that we do very well at Calvert, and we pride ourselves on, is our credit effort. We are very good at looking across sectors. As portfolio managers, we look for relative value in a lot of areas. And in the past, I think you could just maybe own the market and do okay. I think this is a year in which credit selection as well as diversification in investing really shines.
Well, thank you for joining me today, Matthew.
Thanks for having me. It was a pleasure.
On behalf of Calvert Investments and Lipper, I'm Jeff Turnahoy. Thanks for watching.